The annualized returns of the S&P 500 for the decade ending 2023 was 12.2% annually. From January 2014, through December of 2023, if you reinvested your dividends and paid no fees and no taxes, your total return over that time would have been 216%. That's turning $100 into $316. That is the annualized total return with dividends reinvested of 12.2%. But that was just that decade. What about rolling returns? I've warned you before that taking specific individual time frames can prove certain suppositions that may not actually be true in the aggregate. One time frame may prove that stocks are going to the moon and cause people to euphorically overinvest at the top for the first time at the top of a bubble, like 1989 to 1998, where it was up 480% with an average of 20% per year. Others pessimistically prove, quote unquote, that stocks are dangerous and cause investors to flee to safety of bonds and insurance products, like 1999 to 2008, which was actually down 13% over that 10-year time frame, corresponding to the name the flat decade. Therefore, instead of using just one period to prove a principle, we're going to rely on rolling returns, the ongoing average of returns over those same types of periods. So let's dive in, right? We've been talking the last few weeks, so we're taking a few weeks to look at investor versus investment returns. If you missed last week's episode, which was on that investments still outperform investors, go back and listen to that first and then come and catch back up. There in that last episode, we saw that investors significantly underperformed the S&P 500 over every period, but that the numbers were different from the last time we looked at this back in 2021. The 1, 3, 5, 10, 20, and 30-year returns have all changed, both the investor and investment returns. So how can we be sure of our principles when the numbers keep changing? So instead of using a single period to prove a rule, I prefer to use rolling averages. What was the 10-year return ending each year for the last decade, spanning 20 years or more? What was the average of those averages? That's how we get rolling returns, right? They add some consistency to our numbers over time. So when we better understand these rolling returns and how they are positively positive, and they can help us become better investors. And here's the deal, right? Rolling returns are positively positive. Let's look back at the rolling returns of the S&P 500 over the last 50 years, ending 2023. And I'm not cherry picking this just for good. One, I'm using 50 years from the end of last year, but also starts on a down year. So we're not starting off on the best foot. But we'll look at the 1, 5, 10, and 15-year rolling periods. And this might be a good one to watch on YouTube if you're usually a podcast listener, or at least go to the blog post, retirementmentorship.com/168 for the 168th episode. Because we'll have some different graphs and stuff on here, which I think are very interesting and help prove and help you become a better investor if you see these graphs and understand them. So first of all, let's look at the positive probability, right? We'll have a graph in there of the years, just the annual return each year. Most of them are positive, right? You do have a few glaringly bad years in there. 1974, 2000, 2002, 2008, 2022, etc. But overall, the probability that the stock market, that your equity investments are positive over the course of a calendar year is 80%, right? 80% of calendar years, you are up over the course of that year. But your chances get better the longer you hold, as shown in the graph, and we'll put this up again on the YouTube screen for you. But over a rolling 10-year period, and in the last 50 years, the returns go from 80 to 84 to 86 to 96% positive over a 10-year period. And then if you stretch out all 15-year periods, they're all positive. There are no 15-year periods where the market is down. And that's the thing, right? People often equate the stock market with gambling. But tell me, what casino do you know where you can go to where there's an 80 to 100% chance of winning? It just doesn't exist. Gambling and investing in equities are not the same. And so your chances, the probability that you have a positive outcome when investing over even short periods of time are pretty good, but over long term, obviously gets completely positive. What about how positive is that, right? What was the average total return with dividends invested over those rolling periods? So sure, in 16% of 3-year periods, the market is down, right? If it's positive 84% of the time, that means 16% of the time the market's down. But it's up so much over the other 84% that your rolling average for those 3 years is still 41%. Over most, on average, over a 3-year period, you will be up 41% investing in the S&P 500. So despite having 2 negative 10-year periods over those 50 years, on average, the 10-year time horizon for investing is so good that you would be up 200%. And again, because when you start taking percents, like hundreds of percents, I think we forget what that means. Up 200% means you turn $100 into $300. On average, you would have tripled your money over a 10-year period in the S&P 500 and quadrupled it over 15 years with no chance of it being down over 15 years. That is incredible. So let's look at some more of these 10-year periods, right? So there are only 2 rolling 10-year decades, which is what a decade is, right? There are only 2 rolling decades that had a negative return. Can you guess what they are? They were the decades ending 2008 and 2009, right? Right in the middle of the Great Financial Crisis. And why were those 10-year periods negative? Because you were measuring from the top of the dot-com bubble to the bottom of the Great Financial Crisis. Right? So if you look at the end of the 90s, for 5 years in a row, there were 20+% annual returns. And that's because, was it recovering from a crash? Is that why they were so good for so long? No. The 4 years before that were also positive. So you had 9 positive years in a row, and the last 5 were all 20 to 30% every single year. That is a bubble. And when you measure from the top of a bubble 10 years forward and you end up in the bottom of with the greatest financial crisis since the Great Depression, yes, you're going to have a negative 10-year period over that time. And from 98 to 2000, the 10-year rolling average was 400%. You would have 5x your money over those 10-year periods. That's abnormal. That's not normal. That's a bubble. And if we find ourselves back in that situation, we can bet that it will pop again, right? So when you measure from the top of a bubble to the bottom of a crash, yes, you are going to get a negative return decade. And so you hear this a lot. People talk about the flat decade, but when they're trying to make you scared of investing, usually to sell a life insurance product or an annuity or something like that, they'll often talk about the flat decade, where from, the early, from the basically 2000 to 2010, or from 1999 to 2009, whatever. It's like there's a couple of 10-year periods in there where you were basically flat or maybe even a little bit down. And so didn't people get screwed during this period? Didn't they get, they thought equity investing was the way to go. They invested and then they got totally screwed during this flat decade. Isn't that what happened? No, that only happened to people who succumbed to either euphoria or panic, which we covered about in episode 4. If you started investing in 2000, for example, then the dot-com crash and the Great Financial Crisis were the best things that ever happened to you. You were able to buy on great sales over and over again just as you were starting out your investing journey, right? So for anyone who's younger or who's been investing for 20 years, kind of Gen X, millennial, those kind of people, it's been a great run for you. So that didn't hurt you at all. The flat decade didn't hurt you at all. What about for people who are trying to retire in 2010? And for the last 10 years, it had gone flat or maybe even a little bit negative. It wasn't that bad for them. Didn't it screw them? But again, here's the thing. If you had been an equity investor for your whole career before that, for 30 or 40 years before that point, you would have made so much money in the 90s that those 2 crashes would have just brought you back down to where you should have been without those. Right? The long term, that 20, 30, 40 year return over that time is still overwhelmingly positive. And so it was only the people that didn't believe in equity investing, despite all the evidence throughout the 80s and 90s that was great, and got in at the end of the 90s, and only were invested in equities through that period. Those were the only ones that were hurt by it. So the flat decade is not something that would hurt a good, solid, long-term investor who had been invested for a long time or was planning to stay invested for a long time. And that's not you, right? You are a business owner. You are invested in equities for the long term, and we are just here to reinforce that. And so what about monthly rolling returns, right? Because not everything happens on calendar years. And I've been using all these calendar year returns from January 1 to December 31st. And obviously life happens monthly, not annual. Not everyone retires on December 31st. People retire all year round. People have emergencies all year round. You need money throughout the year, not just on January 1st. So what about monthly rolling returns? And it's true that that sometimes it can skew a little bit when you only use annual numbers because, for instance, like 2020, we had the COVID crash. It was a really weird year, right? But the year was positive. And so it doesn't show as a negative year, even though we had the fastest crash we've ever had of 33% down in 35 days or whatever, 35 down in 33 days. And so that won't even show up on an annual graph, but it will show up on a monthly graph. So what about monthly rolling returns? Well, we don't have monthly return data going back to 2000, so I can't do a 50-year analysis like we can with annual returns. And so to me, 24 years is not enough for good like rolling 10-year data, but it's plenty of time for 3-year periods. And so let's look at it, right? And again, we'll have a graph of this, but if you look at rolling 3-year return data, you can see that the only years that are negative were during the Great Financial Crisis, right? So when we say that 3-year rolling return periods are positive 81% of the time, the only time that they were down, the other 19%, all happened in the global financial crisis, which again, hopefully is a once in a century kind of crisis. Could happen again, of course. We will be prepared for it as planners, right? As solid investors. But more than likely, that's the only reason they're negative. All the rest, ever since then, every single 3-year monthly rolling 3-year rolling return period on a monthly basis, they've all been positive. Every single one. The lowest point since the Great Recession on a 3-year rolling average was at the end of March of 2020, which was the bottom of the COVID crash, right? Where for a brief moment you were only up 16% from 3 years before. And if you waited just 1 month, you were back to 30% up and 40 and et cetera, and you were on from there as it recovered. And so even in a global pandemic, the worst you ever got from 3 years before was 16% up. That's incredible. Does this mean that we throw all of our investments, all of our short-term savings into the stock market because, hey, it's almost always up over a 3-year period? No, like we still stick to all of our prudent investing rules. But it does mean that the next crisis-induced market drop may not take 5 or 10 years to recover. More than likely, you will have a positive return within 3 years. And returns that are way better than anything else. Right? Because even at 16% up over 3 years, at the bottom of the COVID crash, that's still 5% a year, which is still better than you could have gotten in pretty much anything else at that time. Right? And if you wait another month, you're 30% up. That's 10% on average over the course of 3 years. And you were just not going to get that anywhere else. So nothing has the upside of equities, and even the downside of equities pass very quickly. So investors underperform their investments because they don't mentally or emotionally understand how investing truly works. But when you are a business owner, right, in the best business in the world, when you think about it in that way and you know that your returns are positively positive, it gives you the mental fortitude to then to help change your emotions so that you can stay invested and close that gap between your investment and your investor returns. Just give it time and maybe even less time than you think, and you will be back to positive. I hope that helps. We'll continue on this theme for the next few weeks. We'll see you next week. Cheers. If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership, and it has a host of benefits, all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time. We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, where you can click in the link in the description and it'll go right there. We can't wait to see you in the community. Cheers. This podcast is educational only and is not investment, tax, or legal advice.